Stock market technical analysis for beginners. The stock market can seem like a complex and intimidating world, filled with numbers, charts, and jargon. For those just starting, the question of how to make informed decisions about buying and selling stocks is crucial. While there are two main approaches, fundamental analysis and technical analysis, this guide will focus on the latter. Technical analysis is a method that focuses on market activity, such as price and volume data, to identify patterns and trends that can suggest future price movements. It's like reading the market's footprints to understand where it might be headed. This narration aims to provide a simple and straightforward introduction to stock market technical analysis for beginners. Understanding the basics. What is technical analysis? At its core, technical analysis operates on a few key principles. Market action discounts everything. This means that the current market price of a stock already reflects all available information, including fundamental factors like company earnings and news. Technical analysts believe that instead of analyzing these factors, it's more effective to study the price itself. Prices move in trends. This principle suggests that stock prices tend to move in patterns over time. These trends can be upward, uptrend, downward, downtrend, or sideways, ranging. Identifying these trends is a crucial part of technical analysis. History tends to repeat itself. Technical analysts believe that past price patterns and market behavior can provide insights into future price movements. This is because market psychology, the way investors react to market conditions, tends to be consistent over time. In simple terms, technical analysis involves looking at charts and using indicators to find repeating patterns in stock prices and trading volume. Key tools of the trade: charts and indicators. Technical analysts use various tools to analyze market data. Here are some of the most common. Charts. Charts are visual representations of price movements over a specific period. The most common types include line charts. These simple charts connect the closing prices of a stock over time. Bar charts. These charts show the opening, high, low, and closing prices for a given period. Candlestick charts. Similar to bar charts, candlestick charts provide a more visual representation of price movements, with different colors indicating whether the price went up or down. Indicators. Indicators are calculations based on price and/or volume data that help to identify trends, overbought or oversold conditions, and potential buy or sell signals. Some popular indicators include moving averages. These indicators smooth out price data to help identify the underlying trend. A simple moving average, SMA, calculates the average price of a stock over a specific period, e.g., 50 days, 200 days. Relative Strength Index, RSI. This indicator measures the magnitude of recent price changes to evaluate overbought or oversold conditions. Moving Average Convergence Divergence, MACD. This indicator shows the relationship between two moving averages and can help identify changes in trend. Volume. Volume refers to the number of shares traded in a given period. High volume can confirm the strength of a trend, while low volume may suggest weakness. Spotting patterns. Chart patterns. Technical analysts also look for recurring patterns on charts, known as chart patterns. These patterns can suggest potential future price movements. Some common chart patterns include head and shoulders. This pattern can indicate a potential reversal from an uptrend to a downtrend. Double top bottom. These patterns can also signal potential reversals. Triangles. These patterns can indicate either a continuation or a reversal of a trend. Putting it all together, a simple approach. For a beginner, a simple approach to technical analysis might involve identifying the trend, look at a long-term chart, e.g., daily or weekly, and use a moving average, like the 200-day SMA, to determine the overall trend. If the price is generally above the moving average, it's an uptrend. If it's below, it's a downtrend. Looking for support and resistance. Support levels are price levels where a stock tends to stop falling, while resistance levels are price levels where a stock tends to stop rising. These levels can help identify potential buying and selling opportunities. Using a simple indicator, add one or two simple indicators, such as the RSI or MACD, to confirm the trend and identify potential entry or exit points. For example, if a stock is in an uptrend and the RSI is oversold, it might be a good time to buy. Watching volume. Pay attention to volume to confirm the strength of price movements. Conclusion. Technical analysis is a valuable tool for understanding market dynamics and making informed trading decisions. While it may seem complex at first, the basic principles are relatively straightforward. By understanding trends, using charts and indicators, and recognizing patterns, even beginners can start to decode the market's behavior. However, it's important to remember that technical analysis is not foolproof, and it should be used in conjunction with other forms of research and sound risk management practices. The stock market involves risk, and no analysis method can guarantee profits.